Good afternoon and welcome to the Prudent Money Radio Show. I'm your host, Bob Brooks. Thank you so much for joining me today. You know I do appreciate it. Well, analyst and best-selling author Harry Dent has accurately forecasted many events. I remember when I first started in the business, Harry had released a book called The Great Boom Ahead. I remember reading that book from cover to cover, and that was 1994. I also remember the environment then in 1994. Not a good year for the market. The Fed had started raising rates in February. The forecasts were not good, and here was Harry Dent forecasting a booming economy and a stock market. Many thought he was wrong. Turned out he was dead on. From 1995 to 2000, what he wrote about happened. Today, he brings the opposite message in a book, 0 Hour, as well as a preview regarding his upcoming book, 2020, The Tipping Point. Harry is here to talk about what lies ahead. Harry, welcome to Prudent Money.
Yeah, nice to be back, Bob.
Let's go ahead and fast forward to 2020. Describe what you see happening in the market and the economy.
Well, I have a number of cycles. I started out with the spending wave in 1988. That was a breakthrough indicator. I'd been just researching demographics and cycles for decades for my business clients as a consultant, and I just came to this breakthrough indicator, and it said U.S. and Europe were just about to see their strongest baby boom spending in the 90s and beyond, and Japan had already seen it was going to collapse. I mean, that was the most radical forecast I ever made, that the 90s was going to see Japan collapse in 1989, and that was my first self-published book. And then the U.S. was going to have the greatest boom in history, and the Dow would hit 10,000 by 2000, all this stuff. People thought I was an absolute crazy man back then. So now what we had, I have three long-term indicators that are all important. The demographic is the primary. The technology cycle is the other very important thing that impacts productivity. That comes about every 45 years. But I also, after 9/11, I had to realize, the geopolitical environment changed drastically and is still very negative with, one mass shooting and terrorist event and civil war and now the standoff with Iran. By the way, we're about over that cycle. That's the good news on that one. But I have three cycles, and they're all converging down. The geopolitical cycle went negative 2001 with the least impact, more on stock valuations. The demographic cycle, as we said, peaked in late 2007. Baby boomers peaked, and we've been on quantitative easing and in the emergency room, trying to survive ever since with 2% growth despite massive stimulus and now tax cuts from Trump. We always go back to 2%. But the last indicator, the innovation and technology cycle, peaks every 45 years, and every other cycle you get kind of what I call a double bubble or a double cycle, like 1929, the biggest crash in history after the Roaring '20s. And before that, 1837 to 42 crash. Those crash bottoms are exactly 90 years apart, and this bubble is now, this is the last cycle to peak, and the Fed is playing right into it. All this stimulus, hey, the boom really should have been over in 2007 by the most fundamental reason, but with this technology cycle, with the internet peaking and cryptos emerging and all the bubble around that and all this stimulus, this is looking just like 1929. So I'm predicting somewhere between late this year, early next year, and at best, if Trump can pull off one more, like send everybody a $5,000 debit card that has to be paid, spent by the election or something, or I actually was really talking about sending payroll taxes. It'd be similar temporarily, but he might be able to push it off 1 year. The signs are just this is looking bubbly, especially if stocks continue to break up. My first scenario is if we can break the substantial new highs here, over 28,000 in the Dow, we're probably going to go to 33,000 in the Dow, 10,000 NASDAQ. That would be the final blow-off bubble that kind of started when Trump got elected by surprise. That's when I've been warning about this bubble bursting, but when Trump got elected and the markets reversed 2,000 points overnight, I said, oh, no, this is final blow-off bubble. So I think this is getting close, and it's hard to do this, Bob, because, this only happens once in a lifetime, and even a little less than that. The last bubble crash like this was 1929 to 32, so nobody expects this. And I'm down here in Puerto Rico, and I've got a really top advisor here that are actually pushing me to the richest people down here. And he's getting big response because people make sense when you see this and show the evidence, but nobody's being told this, and it's really, you're never going to hear. No, Even the most bearish people say we might have a 40, 50% correction. We're talking a 70 to 90% correction in stocks. Everything worse than 2008-9 crisis. That was just the beginning of the winter season, I call it, after the baby boomers stopped spending and a debt bubble. But they stopped that with, it's now $16 trillion globally of money printing and tax cuts here in the United States. They're throwing the kitchen sink, trying to keep the bubble going, and the bubble keeps going, especially in stocks and also in real estate. But the economy's still growing at the same rate it did from 1929 to 40, 2% a year in real terms. This is even slightly slower than that period. So this is the worst recovery in history, despite massive stimulus. And all we've done is created an even bigger stock bubble, a second bubble in real estate. Now, people say, oh, but Harry, the stock bubble's way higher. We can see that. But the real estate bubble's just about the same as last time. Well, it's not Manhattan, San Francisco, or Miami, the most bubbly market. Certainly not in China or Sydney, Australia, or Singapore. But what I show is I have a great way of forecasting real estate that's not just the peak buyers, the next, like the millennials coming along, but it's the dyers, people who die and are sellers. And never have we had a generation in larger numbers dying than the young generation coming on by. This is a first in history. Japan's been in a real estate slump because of that for 30 years now, and they've been stimulating 3 times as much as us. So real estate's going to go down more like 50% instead of 34% last time. So this is not something to kind of just listen to your normal stockbroker and say, oh, that things always, they go down, but they always come back to new highs, and we have you diversified. No, 2008-9, everything went down. That's going to happen again. Everything but high-quality bonds and the best cash flow rental real estate. That's what, even gold went down in 2008, and of course commodities go down. So this is a reset that happens once in a lifetime, every 2 generations, every 90 years especially. And nobody's going to see this coming. And it's very simple. You just think like Joseph Kennedy. Everybody's buying stocks. Everybody thinks this isn't a bubble. Everybody thinks we're in a new plateau of prosperity and the Fed won't let this in. That's when you start selling. And boy, when it collapses and you just buy stuff at 10, 20 cents on the dollar and the other side. Joseph Kennedy went from 55 million net worth back then to 3 billion. Most of that happened when he got out and rebought at the best possible time in all of history to buy stocks down 89. I mean, blue chip stocks, General Motors, Ford, RCA, the very best stocks bubbled the most and then crashed. Well, that's happening now. The FANG stocks bubbling, they're going to crash the most. And, crypto is the next big thing, but it's in a hype bubble like internet was in just the last year in 1999 of the last tech bubble. Well, this is tech bubble too, and this one's higher and bigger, and the cryptos are going nuts at the top of this. Well, they're going to crash big time, and then they'll have. I mean, buying the best Bitcoin-like companies at the bottom of this will be like buying Amazon in 2001 at $6 after it peaked at 160, and of course, in this bubble, it's gone to over 2,000. So this is a huge opportunity. I have to stress to people, it's a huge opportunity, but it only happens if you protect yourself, preserve your capital, and have the resources to buy real estate and stocks. And we're telling people, not only in 0 Hour, but especially in this up-and-coming book, tentatively titled 2020, The Tipping Point, probably going to come out early next year. The place to buy, I mean, commodity bubble is going to be strongest when emerging countries are driving. Southeast Asia and India are going to be the place. China, even though Asia is the place, but Southeast Asia, China, gold will be a super investment, but it's going to go down first, and it's not going to protect you in a deflationary environment any more than it did in 2008. So this is a huge opportunity. I had a book back a few years called The Sale of a Lifetime. That's the way I see it instead of the crash of a lifetime, but it is the crash of a lifetime. You will not see something like this. I can even tell people, Bob, older people I talk to now, when their kids and grandkids will experience the next kind of major crash and depression, and that'll be between 2065 and 74. My indicators are that good and solid on long-term cycles to say, when's the next time all 3 of these big cycles turn down together? That's when it happens. But we don't have to worry about that now. We just worry about the next 2 to 3 years. Once we get over this, some people will also say, if this happens, God, we're going to be in a 10-year slump or a 30-year slump like Japan. No, This is the opposite of the Great Depression. The big crash is coming at the end because we kicked the can down the road, and it will largely be over by 2023, give or take. It's just that the next boom will not be as strong, and you really will make the most profits. India is going to be like buying into India in Southeast Asia in this next crash will be like buying into China before its 30-year unprecedented urbanization on steroids bubble boom. India is the next China. I just put out an article on a newsletter on that. So exciting to me. Just have to see it coming. Don't listen to the experts. Don't listen to your stockbroker this one time. They're usually right about, riding out slumps and just, being diversified and reallocating. This is not the time. This is a reset of everything except the highest quality assets. And you do not want to sit through this.
Well, and what pop culture finance doesn't see is that they would look at the history of what's happened in this country, and they would say, oh, well, 1929 could never happen again. But there's always that probability that it can happen, and so people get lulled to sleep, and that is the big problem with pop culture finance.
Yeah, and again, you look back 90 years before that, as I quoted before, 1837 to 40, that was the biggest real estate crash by far in U.S. history. The Midwest opened up because of canals. Chicago overnight became the next New York. Government gave almost free financing to anybody and darn near free land to get people to move from the East Coast out to the Midwest. Biggest real estate bubble in U.S. history. And I'm telling you, Chicago went up 44,000 times from a cow town to a bubble city and then crashed 99% like tulips. Real estate's never crashed that much. So you go back 90 years on these same convergence of cycles, and you see a major bubble and a major burst. So, of course, after 90 years, people say, oh, that was just a fluke. Well, the farther back you go in history, say these things aren't flukes. Generations boom and bust about every 40-year cycles. Technologies emerge and create the next surge in productivity every 45 years. Geopolitical cycles go up and down every 35 years. These are not things that change. Other things do. And that's why I can look back and then look forward and literally tell people, not just when your kids will experience a depression or your grandkids, but I can tell you when these cycles converge together for years and decades ahead, and when they're kind of more mediocre and when they converge down together. This is something you're not supposed to be able to do. I tripped on this only because I stopped taking economics in college because I realized it was a failed science that couldn't predict anything, and found my own way through consulting with real Fortune 100 companies and then with entrepreneurs creating the future. That's how I discovered the baby boomers and demographics. When I started consulting to new ventures in California instead of Fortune 100 companies from Boston, all of a sudden, they're dealing with a whole different customer. They're dealing with young baby boomers. So I had to study the baby boomers, and I'm like, the world does not see this huge, very different, very creative, game-changing generation coming. And that's how I made all my forecasts, Bob, back there in the late 80s and early 90s where people thought I was crazy. It was a piece of cake. The indicators were crystal clear. You just have to be looking at the right indicator.
Well, and this time around, I think that you got to be realistic because it does make sense. I mean, you can't carry this much debt, and at some point, something's got to come into the system and detoxify the system out and clear out all this debt. But like you say, and I want to make sure that people hear this, is that none of this should be taken as gloom and doom. This is an opportunity to prepare yourself and not only survive, but thrive in the midst of what is happening. And it's just unrealistic to think that they can keep kicking the can down the road.
It is. And, I hate to say, it's just like the addiction cycle. I mean, this is well proven and studied medically and everything. We are addicted now to free money, injections, stimulus, financially enhancing drugs is what all this quantitative easing and zero interest rates and tax cuts. I mean, you don't cut tax cuts at the highest profits in history. You cut taxes like Reagan did when they're low. And we have a lack of supply because of inflation and stuff. So this is all wrong. We're addicted to this stuff. And addiction, it takes more and more, and that's what we get, more and more stimulus just to keep the thing going. And at some point, you're right. I mean, it gets too toxic and the system collapses, and you have to deleverage, detoxify the debt. It's a liquefaction process, deleveraging. Just like when you get sick, if you get really toxic, what does your body do? It flushes everything out, and you get really sick. An addict. If you don't die, your only other option is to go to rehab, detox, and then you have a chance of getting healthy again. So this is going to cure what David Stockton and I both call the corruption of capitalism and democracy, which has happened. There's not something wrong with capitalism, democracy. That's what's made us rich since the late 1700s when they emerged together. What's happened has been corrupted. Central banks have taken over the free markets by setting short and long-term interest rates through QE. You set the value of reset the value of all assets to positive. Real estate does better with zero interest rates. Stocks, all these things get leveraged. So you create these bubbles. You encourage excessive debt. And then, of course, these bubbles have to detox and it gets out of whack. Another thing I remind people, Bob, I'm just writing this in an article today for my newsletter. No accident that the Federal Reserve was first created. We didn't have a central bank for many decades before that. Was first created in 1913, and then you just count 2 decades later, 1933, we're at the bottom of the worst depression in history following the greatest bubble in U.S. history. These central banks always stimulating, don't let the economy have its little cold and rebalance along the way and flush out some bad companies and bad debts and banks and stuff. That's healthy to do that. No, we just keep bubbling, and so what do? You get the giant detox, 1929 to 32, 33, and that's what we're going to get here. I mean, you look at history from my view, from the 30,000 feet, couldn't be more obvious. The only question is, how long can they keep this bubble going? And by the way, I used to do this in the 90s when I was talking to stockbrokers and living on the road. I used to throw up as a joke. I say, look, here's what a bubble is. Here's 1920s bubble. And that's exactly I can throw every market in the world, real estate, commodities, they're all following this model. And when it crashes hard. There are no soft landings. And my biggest warning to investors who think, well, maybe I can wait and see if Harry's right and then get out, after the first correction and it looks more. No, the first correction of a bubble like this is 40 to 50% in 2 to 3 months. It hits so hard that people just panic and get out. Then there's a bounce, which nobody will be around to see, and then it goes down that 80, 90%. But you get whacked at least half of the whole major crash and reset in the first 2 to 3 months. You do not want to be caught in that.
Well, let me mention your website. It's a great resource. And correct me if I'm wrong, Harry, there's a way to get a free copy of the book 0 Hour.
They often offer that. Sometimes they do something, but you can for sure. We always offering. We have a daily newsletter for people to get to know us. So we have a free newsletter. All you go to harrydent.com. You just put in your email address and you're on. It's that simple. And you just get to know us. And yeah, often you'll go there and they're offering, if you want to do a trial subscription to our paid newsletter, you can get a free copy of 0 Hour. So yeah, I mean, we just want people, we're just trying to warn people. That's why we're giving away free stuff. We just want to warn as many people as we can, because it's a shame to build up wealth over decades. Part of it through hard work and frankly, part of it just through pure speculation and over-leveraging. But it's just a shame because this will be reset. And history is very clear on this in a matter of 2 to 3 years, and it will be nasty.
Yeah, and I remember some of those speeches. I got to see you speak a couple of times in the 90s, and it was just funny to see the reaction of people in the room as far as your forecast going and just people just not buying into it.
Yeah, the flip side, though, I mean, one of the things we do right out the bat, just say, look, what really drives the economy? Consumers are 70%. The businesses that expand to meet their needs are the other 10. 80% of the economy is driven directly by consumers, and nobody studies them. Guess what consumers do? Enter the workforce age 20, earn and spend more money as they get married, have kids, buy houses, and do all the things people do and get them in through school and college, and they peak at 46. Now it's 47 millennials. Our simplest indicator, everybody gets, you move forward the birth index, adjusted for immigration, for the peak spending the average family, and that tells you when the trends will be good for the economy and stocks and when they won't. And so why should you be in stocks all the time as a stockbroker tell you? Because they ultimately go higher, when they tend to go up about 26, 27 years with generation cycles, and then largely go down for 13 to 14 years. Why be in stocks when they're in a 13, 14-year down market? Actually, by the way, bonds peaked at the highest inflation rates. I mean, where it's the lowest because they hate high interest rates. Peaked in 1981. I mean, peaked in rates, bottomed in value in 1981. It's been a bond bull market since then. That bull market will be over 2022 because bonds are the one thing that's been a good quality bond, benefit from deflation, a crisis like I'm talking about with everything reset. But there'll come a time where why should you be in long-term bonds when inflation is going to come back for many decades and it's going to work against those? So again, our cycles tell people long-term, how do you plan for your family, your career, your business, your investments? We can tell you, not the short-term stuff, but where things are headed over the rest of your lifetime, and it's not that complicated.
Well, great information, Harry. Once again, the website is www.harrydent.com, and I certainly will be looking forward to your new book that's coming out early next year. Harry, thanks for your time.
Okay. Thank you, Bob.